Okay, so now let's try to understand about this chapter of income taxes, wherein the first concept is what is our inter-period and intra-period income or taxes. So let's take the example of a real world company wherein Apple prepares its financial statement and it follows the GAAP rules. When it files with IRS, it follows the Internal Revenue Code. So basically what happens in US or in other countries as well, when the financials are prepared, they are followed by the Companies Act or generally accepted accounting principles. But when it comes to pay the taxes to the IRS, that is Internal Revenue Code or IRS Department of US, then different kind of I can say adjustments are being done. This creates two distinct number. One is income tax expenses and another is income tax payable tax return, because as per the income tax, tax would be paid differently because income tax will allow something and disallow something. So let's imagine a situation where in Apple buys 1 million worth of servers. So they have bought these servers. Now what happens? GAAP or the financial accounting system says that Apple uses straight line depreciation method over 5 years, which means on this 1 million uh, server, they will be charged depreciation of $200,000. Okay. Now, IRS laws has different treatment. They say that IRS says that Apple uses MACRS, which is accelerated depreciation method. Now, accelerated depreciation method simply means that depreciation is high in earlier years. This is covered in the depreciation section, but I am just repeating that depreciation is high in earlier year, allowing them to deduct $400,000 in a year. Now income tax department itself is saying that you can deduct $400,000 from your income. Now let's see how their financial will look like. So as per the GAAP books, they have earned, let's suppose, $10 million, and as per the IRS, they have earned 10 million as well. So there is no difference. But if you see the depreciation in the GAAP books, you will see a depreciation of $200,000, which is here. But in IRS, you will see a depreciation of how much? $400,000, which will create a difference of $200,000. Now, if you see, the GAAP book income will be 9.8 million, which is 100,000, 10 million minus $200,000, which is 9.8 million. But income tax department or IRS department will be saying, no, your income will be 9.6 million. So the company Apple needs to pay the taxes on this 9.6 million now. Now what happens? If the tax rate is 21%, then Apple's income tax payable to the IRS is only how much? You can say 2.016 million. Basically, how this calculated? This is calculated on 9.6 million multiplied by 21%. So you get this number of 2.1 million as per IRS. Uh, However, their income tax expenses on the income statement will be 2.08 million. Why? Because income tax statement was this, and their books will show 21% taxes here. That will represent 2.058 million, and as per income tax it will be 2.016 million. Now this difference is created. Why? Because there are different methods. Income tax allows different methods, and GAAP, which is generally accepted accounting principles, allows different method. Now we can say the difference between both of these numbers, which is as per the income tax and as per the books tax, the difference of both of them, which is $42,000, is a deferred tax liability. What do we call it as? A deferred tax liability. Why we call it as a deferred tax liability? Because we will understand this thing entirely in the coming chapter. But overall, if you see that the taxes which needs to be paid here are higher, but as per income tax we are paying lower. So in future somehow we will get lower depreciation allowance, because right now we are getting higher depreciation in our books. In future we will get lower depreciation. So somehow in future we need to pay our taxes, and we shall see these things through multiple example. But in future when we will pay our taxes, so the difference right now will create a liability for us. and to that extent we are saying this $42,000 is a liability for us, and we are calling this as a deferred tax liability because these taxes will be paid in future, right? So this is about the basic concept. Now this is inter period allocation. Basically we are saying this is as the inter period. Why? Because right now the taxes are lower, in another year the taxes will be higher somehow, so we call it as inter period, different period allocation in action, and recognizing the tax effect now for a difference that will reverse in future. This difference will reverse in future. Basically we will see this concept in a later on detail, but overall the I can say understanding or basic thought behind this concept or chapter is simple, that somehow there will be difference between income tax and the gap rules, and based upon that there will be differences created on the taxes paid. Now let's see the intra period tax allocation as well. What happens, like, this is about where the tax appears on the financial statements, not when and if Apple has discontinued operation, and this is one of the concepts. So let's try to understand that through direct example, wherein let's see that the Apple's income statement is given, where income from continuing operation is given as 100 million, on which the tax will be levied as 21%, where the tax will be overall 21 million. Now if there are certain losses from discontinued operation, let's suppose there is a loss of 10 million. So if there is a loss, then we know that on the loss there will be a tax benefit of 21%, which is 2.1 million credit. It's as simple as that. You know, when income is higher, income tax charges tax on that, but at the same time when there are losses, you need to remember that IRS or income tax allows that these losses you will get a tax benefit or tax credit of certain percentage. So right now in our example this is 2.1 million. So what will be reported, you can simply say that income from continuing operation, you can say that before tax was 100 million, income tax expenses how much, 21 million. Then you can say income from continuing operation, basically instead of income you can call it as profit from continuing operations. So from this 100 million, taxes are 21 million, so remaining 79 million are our profit from continuing operation. If someone asks you income from discontinuing operations, or not the income, basically the discontinuing operations, how much taxes were there or benefits were there, so you can say when you discontinued operations, some business were closed, on them there were loss, and on that loss we got a benefit due to tax law of 2.1 million. So you will say there is a benefit of tax of 2.1 million in this case, so we have written benefit of 2.1 million. Now what you will say, out of this 10 million, which is I can say was loss, and you will get a benefit of how much, you can say simply a benefit of 2.1 million. So effectively your loss will be how much, you will be saying it's 7.9 million dollars. Okay, why you will say that? Because the losses are 10 million, benefit is 2.1 million, so effective loss is 7.9 million. Now at the end, how will you show that what is your total income? So you will say, okay, from continuing operations I am getting an income of how much, 79 million. From discontinuing operations I am getting an income, or I must say profit, of how much, not profit, here we are having losses of how much, 7.9 million. Okay, and these numbers are in million. So effectively what is your final income? If someone will ask, you will say the net amount of both of them will be my final income, which is 71.1 million. This is 71.1 million, and these numbers are in dollars. So finally your net income will be 71.1 million. So this chapter is not about these intra period or within the same period allocation. This chapter is not about this. We won't be studying this thing. We will be studying only about inter-period within this chapter. This concept of intra-period is only told you just so that you know that if there is certain income, then that income can be set off against certain losses which are there from discontinuing operation. So this chapter we will understand and try to see how does this work. Now let's see the textbook concept quickly, that what does the textbook say. So textbook simply says that accounting for income taxes relies on tax allocation to bridge the gap between financial reporting and tax compliances. There is a difference between financial reporting and tax compliances, as you know. Now what is intra period tax allocation? This is like this process distributes the total tax provisions across specific sections of the financial statement where the underlying items are reported. Simply, what does this do? This simply match the tax effect with their related components to net income and retained earning. Now, this language may be a little bit tricky for you, so we will be covering this in uh, basically introductory sessions of income statement and P&L, and this is not much relevant for us for this chapter, so let's skip this intra period taxation. But the inter period taxation is very important for us because this chapter all belongs to it. Now this simply addresses the timing difference between GAAP and internal revenue code. Income tax department says different things and GAAP says different things, and based on that, in our example we had seen that taxes are calculated and allowed. Now the problem statement is there that financial accounting income often differs from taxable income, as I told you. Then the cause is like there are certain temporary differences in timing of when income or expenses are recognized for tax versus books. One example we saw was depreciation, that higher depreciation in tax and lower depreciation in accounting may be there. What does this results? This simply results in a discrepancy between income tax expenses, book expenses, and I can say income tax payable for IRS. Those are differences. And for that, what becomes the solution? Finally, for that, we create deferred tax assets or deferred tax liabilities, which we will be studying entirely in detail. But overall, you must know that this is the goal of this chapter. We need to identify what is our deferred tax assets and what is our deferred tax liability.